Okay, let's unpack this. Today isn't just a standard deep dive, where we look at a company's earnings or some tech trend.
No.
The stack of sources on the desk today, it reads more like a forensic audit of the average person's financial life. We're framing this as an intelligence briefing.
It really is an intelligence briefing.
Okay.
And the reason for that specific framing is that the source material is asking you to fundamentally shift your identity.
Okay.
Usually when people think about investing, they think like a consumer. They're shopping for stocks, they're shopping for funds, just filling a cart.
Right, I'll take 2 of those and 1 of these.
Exactly. But the sources today are arguing that to actually build wealth in this economic environment, and we're looking at the data leading up to 2026, you can't be a consumer.
So what do you have to be?
You have to be a portfolio architect.
A portfolio architect. Okay, it sounds better on a business card, but what does that actually mean in practice?
Well, a consumer just accumulates things. An architect designs a structure where every single beam, every pillar, has a specific load-bearing purpose. And here's the tension right at the top of the briefing. Most listeners probably feel like they've been responsible. They've read the books, they've watched the videos, and they've built what they think is a safety net.
Sure, they own a bunch of different funds, a little bit of this, a little bit of that. They feel diversified.
And here is where it gets really interesting and, frankly, a little alarming. The data suggests that what most people call a safety net is actually a trap.
A trap.
The sources use a term that we need to define right out of the gate. It's diversification.
Diworsification. It sounds like a made-up word, but I've definitely seen it in the literature.
It's a very real mathematical concept.
Yeah.
It's the idea that by trying to be safe, by buying more assets, you aren't actually hedging risk.
You're just
mathematically guaranteeing mediocrity. You're adding complexity that costs you money, it lowers your returns, and it offers no actual protection.
So the argument is that the old rules of investing, the ones our parents might have followed, are effectively a tax on the modern investor.
Yes. The sources argue that blind diversification is costing investors millions in what they call lost alpha.
Okay, lost alpha. That is a serious claim. So let's dismantle this. If we're architects, we need to look at the blueprints.
Right.
And the first major structural failure the briefing identifies is something they call the illusion of diversity.
Right. And to explain this, the sources use a fantastic analogy that I think everyone can relate to. It's called the buffet scenario.
I saw this in the notes. And we're talking dinner, not Warren Buffett.
Correct. Imagine you walk into a massive high-end buffet. You're hungry, and you want to be, balanced and diversified in your diet.
Of course.
So you grab a plate and head to the Italian station. You load up on some fettuccine Alfredo.
Solid start.
Then you think, okay, I need some variety. So you go to the seafood station. You grab the lobster linguine. Then you see sign for chef's specials. And you grab the house tortellini.
I see exactly where this is going. I have 3 different plates, 3 different names for my food. I feel very culturally diverse.
You feel diverse. But when you sit down and actually take a bite, what are you eating?
It's all pasta.
It is 90% refined carbohydrates.
Yeah.
You haven't diversified your nutrient profile. You've just diversified your ceramics. The plates, not the meal.
That is a light bulb moment. So bring this back to the portfolio. This is the ETF trap.
Precisely. This is the kitchen reality. Investors buy ETFs, exchange-traded funds, because the ticker symbols look different. They see QQQ, they see VGT, they see VTI. They think they're buying from 3 different restaurants.
But they are all cooking in the same kitchen.
With the exact same ingredients.
Yeah.
Let's look at the specific combo the audit calls out, because I bet a significant portion of our listeners have this exact setup.
Okay.
They own QQQ for growth, VGT for a tech play, and VTI for total market safety.
It sounds logical on the surface. I mean, QQQ is the NASDAQ 100. VGT is Vanguard Infotech. VTI is the total stock market. You have a growth engine, a sector bet, and a safety net.
But let's look at the ingredients list. QQQ is 57% technology. VGT is 100% technology.
Okay, so massive overlap there immediately.
But the real killer, the one that tricks people, is VTI. People hear total stock market, and they imagine they own a tiny slice of everything equally, from, lemonade stand to a megacorp.
But it's market cap weighted.
Which means the biggest companies make up the biggest slice of the pie.
Exactly, and the biggest companies are
Apple, Microsoft, NVIDIA. The tech giants have become so astronomically large, they dominate VTI. The forensic data in the briefing is I mean, it's just stark.
How stark?
VTI already contains 93% of the companies found in QQQ.
93%.
93. So think about the architect versus the consumer. The consumer buys VTI for safety, then buys QQQ for growth. But the architect looks at the blueprints and realizes, wait a second.
If I own VTI, I already own the NASDAQ.
You already own it. So if I buy QQQ on top of it and then VGT on top of that, I'm not diversifying.
You're just double buying Apple?
You are double and triple buying Apple and Microsoft.
Yeah.
You are concentrating your risk while telling yourself this bedtime story that you're diversified.
And you're paying 3 different expense ratios, 3 different management fees to own the exact same thing.
It is unintentional overlap. And the consequence isn't just that you look silly. It's that when the tech sector takes a hit, your entire diversified portfolio tanks.
Because it was all pasta.
It was all pasta.
That is. Well, it's humbling. And I think a lot of people do this because they want to feel like they are covering all the bases. But let's move to the second structural failure. If the first mistake is the pasta problem, the second one is even more controversial.
Oh, this is the part that usually gets the angry emails. This challenges the sacred cow of personal finance, the 3-fund portfolio.
The Bogleheads. For context, the classic advice is you buy U.S. stocks, you buy international stocks, and you buy bonds.
Right.
The theory is safety. When the U.S. zigs, international zags, and bonds keep you steady.
That is the theory. And historically, 40 years ago, it had some merit. But the source material asks us to look at the reality of the last decade and the projection for 2026. They use a visual that is really powerful.
Okay.
Imagine a rocket ship.
I'm picturing a rocket.
And that rocket ship is the U.S. stock market. It's trying to take off. It has the fuel innovation, the AI sector, capital markets. But chained to the bottom of that rocket is a massive, rusty, heavy anchor.
And the anchor is?
International stocks and bonds.
That is a brutal image. But we can't just go off vibes or, national pride. We need the hard numbers. What does the performance data actually say?
The numbers are, they're undeniable. If we look at the last decade, U.S. stocks, so VTI, have returned approximately 11% per year.
Solid. That's wealth building.
Now look at the anchor. International stocks, represented by VXUS, returned about 3.7% per year.
3.7. That is barely beating inflation. In some years, that's losing to inflation.
And bonds. BND returned about 1.3% per year.
1.3%. You are literally losing purchasing power.
Precisely. And this is where the diversification argument really hits home. The view here is that adding these low-performing assets just to be safe is effectively a tax on your future wealth.
So you're voluntarily taking your high-performance engine and just diluting it.
Yes.
It's like watering down a fine wine. You have this vintage Cabernet and you pour a cup of tap water into it because you're afraid the wine might be too strong.
That's a great analogy. And we have to look at the economic context mentioned in the briefing. The argument is that we are in a bifurcated economy. Innovation, tech dominance, AI, these growth drivers are overwhelmingly concentrated in high-quality U.S. equities.
So the argument is, why bet on economies that are structurally slower, that are dealing with worse demographics, and that lack the tech giants just to fill out a pie chart?
Exactly. By blindly following the old rules and rolling 20 or 30% in international funds that barely beat inflation, you are anchoring your own success.
But wait, I have to play devil's advocate here. Isn't the whole point of diversification to protect against the unknown, reversion to the mean? Just because the U.S. won the last decade doesn't mean it wins the next.
That is the standard rebuttal. But let's look at Warren Buffett. He's the king of value investing, right?
Right.
But do you remember what he specifically said about diversification?
I believe the quote is something like, diversification is protection against ignorance.
Protection against ignorance.
Yeah.
What he means is, if you have no idea what you're doing, if you can't read a balance sheet or understand macro trends, then yes, buy the whole haystack, buy everything.
But if you're a portfolio architect?
If you're trying to design wealth, then blind diversification is an anchor. It's about intentionality. You have to know why you own something.
Okay, so we've covered the overlap, the pasta, and the anchor. But there is a third trap in the briefing. And this one isn't about what you buy. It's about how you behave. The outline calls this the tinkering tax.
This is purely psychological, and I think every single listener can relate to this. The source calls it shiny object syndrome.
Oh, I live this. You're scrolling through YouTube and you see a video, the top 3 dividend REITs for passive income, and you think, I need that.
And then a month later, you see another one. Why AI semiconductors are the future. And you think, oh, I need that too.
And suddenly your portfolio looks like a junk drawer?
It's worse than a junk drawer. The sources use the garden analogy here. Imagine you plant an oak tree in your backyard.
Okay.
You dig the hole, you put in the sapling, you water it. But then, a month later, you decide you'd rather have a rose bush. So what do?
I dig up the tree.
You dig up the tree.
Hmm.
You sever the roots that were just starting. You plant the roses. But then a month later, you see a cactus that looks really cool. So you dig up the roses.
And nothing ever grows.
Nothing ever grows because nothing ever takes root.
Yeah.
Compounding needs time. It needs uninterrupted duration.
So when you constantly switch strategies, you're just resetting the clock.
Constantly. From growth to dividends to crypto to value, you just keep resetting the clock on yourself.
There's another analogy in the notes that I found hilarious but also painful. The bar of soap comparison.
Yes. Your portfolio is like a bar of soap. The more you handle it, the smaller it gets.
This of taxes?
Taxes, fees, bid-ask spreads. But mostly it gets smaller because of human nature. The tinkering tax is usually triggered by emotion.
By fear and greed.
Exactly. You sell the oak tree because it looks small. That's fear.
Yeah.
You buy the cactus because everyone else is buying cacti. That's greed. You're reacting, not designing.
The source makes a bold claim here. Consistency beats optimization.
It does. A mediocre strategy that you hold for 20 years will beat a perfect strategy that you change every 6 months.
That is profound. Okay, so we've identified the 3 failures. The pasta, the anchor, and the tinkering. Let's get practical. The briefing ends with the verdict.
Right.
These are the rules for the portfolio architect. Rule number 1.
Rule number 1, check your overlap.
And how do we do that practically?
Don't guess. Use an ETF overlap tool. There are free ones online. Plug in your ticker symbols. If you see that 2 of your funds share more than, say, 30 or 40% of the same holdings, you have to ask a hard question.
Why do I own both?
Why do I own both? Be a sniper, not a shotgun. If you want to own Apple, or own the one ETF that holds it best. But don't pay 2 different fund managers to buy it for you.
Consolidate.
Consolidate. Okay, rule number 2. This one is going to be harder for the traditionalists who love their pie charts.
Rule number 2. Cut the anchors.
This is the international stocks and bonds.
Yes. Now, important caveat here. If you are retired and you need fixed income to live on right now, bonds have a place. We are not telling your grandmother to dump her bonds.
Right. This is for the wealth builder.
Exactly. If you're in the accumulation phase, if you have a 10, 15, 20-year horizon, don't hold international stocks or bonds just out of guilt. Don't hold them because a brochure told you to. So if they aren't serving your goal, which is growth,
Then they are just dragging you down. You cannot beat the market if you are just blindly buying the average of the entire planet, including the parts that aren't growing.
okay. And finally, rule number 3. Probably the hardest one of all because it requires doing nothing.
Rule number 3, stop touching it.
Put down the bar of soap.
The best portfolio is the one you can hold for 10 years without logging in. The market rewards clarity, but it rewards patience even more. Once you build this architecture, once you strip away the overlap and cut the anchors, you have to trust the design. Let the tree grow.
It really does come down to mindset. We started this by saying we wanted to be architects, not consumers. An architect designs the building, but they don't go back every week and start moving the support beams around.
That's a great way to put it. If you keep moving the beams, the house collapses.
So what does this all mean for the listener right now?
It means that simplicity is actually the ultimate sophistication here. The market rewards clarity. It doesn't reward complexity. You don't get extra points for having a complicated spreadsheet with 30 different funds.
That brings us to the key takeaway of this whole deep dive. I mean, if you remember nothing else from this briefing, remember this line. It really stuck with me.
You don't get a prize for owning the most ticker symbols. You get a prize for making money.
Say that one more time.
You don't get a prize for owning the most ticker symbols. You get a prize for making money.
That's it. That is the filter. When you look at your brokerage account, you have to ask yourself, is this collection of symbols here to impress people with how sophisticated I am?
Or is it engineered to actually generate wealth? And that leads to a final thought I want to leave the listener with. It's about identity. The source asks a provocative question. Are you investing like a janitor or a genius?
Whoa. Okay. No offense to janitors, but in this context, what's the difference?
A janitor investor is constantly cleaning up messes. They buy something, it drops, they panic sell, they buy something else, realize it overlaps, and have to rebalance. They're always working, always scrubbing, always fixing. Reactive.
And the genius.
The genius of the architect owns the future. They set the structure, they align with the highest quality assets, and then they step back. They let the compounding do the work. The future belongs to the owners, not the tinkerers.
That is powerful. The future belongs to the owners.
It does. And in 2026, with the way the economy is moving, you want to own the engines of growth, not the anchors of the past.
So here is your homework, listeners. Before our next deep dive, I want you to log in, look at your safety net, do the forensic audit, check for the pasta problem. Are you double paying? Are you watering down your wine?
Be the architect.
Exactly. Thanks for joining us on this deep dive. We'll see you next time.
See you next time.